The best stock to buy for 2025 is Uber. Uber Technologies is my top stock pick for 2025. Now, this is considerably riskier than my top stock pick for 2024, which was Alphabet. And Uber has several large risks that I will highlight in this video. Before I highlight the company's risk, I'll share with you the reasons why I've picked Uber as my top stock to buy, including the valuations. I'll share with you my discounted cash flow valuation model with several different scenarios that point to how incredibly undervalued Uber Technologies stock is at the current share price of $61 per share. I'll also share with you various industry market forecasts for ride hailing and food delivery and other delivery sources. And finally, I'll close by talking about the major risks facing Uber, most notably the increase in autonomous vehicles that could potentially put Uber completely out of business. So I'll talk about all of that in this short video. So let's get right into it.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
So one of the primary reasons why I like Uber is because it has proven just how much people love its product. The customer value proposition, which is one of the 6 steps in my 6-step investing framework, one of the more important steps, has proven to be excellent. People love the service, whether it be ride sharing or food delivery. People have shown an increasing willingness to pay for Uber's services. $42 billion in trailing 12-month revenue for Uber, and that's grown from a little over $10 billion in 2019. The company has quadrupled its revenue over the last 5 years, and I wouldn't be surprised if revenue growth continues for Uber as more and more folks start to see the convenience advantages of both the ride sharing and food delivery. It's becoming more expensive to own a car in all parts of the world. And so ride sharing is becoming an increasingly attractive option for many, many individuals. When you consider the cost of car ownership, the total cost of ownership, the car payment, the maintenance, gas price, fuel price, energy price, whatever, charging price, whatever you use to fuel your vehicle, the insurance cost, the registration, taxes, etc., all of that combined is adding up to be an incredible sum of money. Whereas if you were to just use ride sharing to travel to work and home in your various use cases, you'll find that it's an attractive option and a more convenient option. And I think more and more people around the world are realizing that. And same with the food delivery side of the business. It might cost you, you might think of it on the one hand, you might say, well, paying $8 to have a $20 meal delivered is almost a 50% fee to have my food delivered. But you could think of it in another way. You could think of it as I'm paying $8 and it saves me anywhere between 30 minutes and an hour for having to go to a restaurant, order the food, and then bring it home, or however you might be consuming the food. And it adds a convenience option where you don't have to leave your house. The food gets delivered to your home. And if we've learned anything about human nature in these last thousands of years, it's that people would love to pay for convenience. People love convenience. If you make things easier for people, they're willing to pay for it. And Uber is one and another evidence of that, where people love convenience. The next thing about Uber that has me excited about this investment is the return on invested capital at 19.2%. You can see it rising considerably over the years. Now, one of the key elements about Uber is that they get to benefit from other people's assets. People volunteer their vehicles in service of Uber. Not only are people that work for Uber volunteering they're not volunteering their time, they're getting paid for their time, but they don't consider that they're kind of volunteering their assets, their car, right? Some people's cars are valued between 10 and 30, $40,000, and they're using it in service of Uber. So Uber gets to benefit from tens of thousands of dollars in people's assets without having to pay upfront for that capital. So they get a massive capital base that they can generate revenue and profit from that they're not having to pay for upfront. Sure, it might be incorporated in the fees that drivers earn, but Uber gets to benefit from that large capital base without having to pay for that upfront. And that's a huge advantage in business. It's not unlike if a friend would let you say, hey, would you mind holding $100,000 for me this year? I don't have anywhere to put it. And you say, sure, I'll take that $100,000. I'll put it in a certificate of deposit earning 4%. And on that $100,000, I'll earn $4,000 this year. I'll give you back your $100,000 and I'll have the $4,000. That's kind of like the scenario Uber benefits from, where its drivers allow Uber to utilize their assets, which is their vehicles, and then the drivers get to keep their assets. They're not giving it to Uber, but Uber is getting to benefit by generating revenue and profit from those assets that they're not directly paying for. And Uber's operating profit margin has grown nicely over the years as it starts to benefit from economies in scale. At 6.4%, the operating margin is significantly higher than the negative 75% in 2020. And this improvement has accelerated since the CEO Dara Kashkari, which I believe is one of the best CEOs based on the performance over the recent 4 years or the recent years, what he's been able to do at Uber, I felt has been an incredible job compared to what the previous CEO and the previous leadership team was doing with the company. So, a strong leadership team that's demonstrated success, which this current leadership team at Uber has demonstrated, is a positive in looking ahead for the company's longer term performance. And then looking at the balance sheet, it's not a pristine balance sheet. The company does have $11 billion in long term debt, but they also have over $9 billion in cash. So their net long term debt is less than $2 billion, and they've got sufficient capital to invest in whatever growth projects they may want to invest in. And the company is generating comfortable free cash flow now. They've been positive free cash flow and their free cash flow is growing. So cash and investments not going to be a restriction for Uber. And they can even utilize some of their newer cash flow that they generate to incrementally pay down that long term debt, which will then lower the interest expense and then increase profitability. Because remember, I highlighted earlier, Uber doesn't need to use a lot of capital to reinvest in the business because the drivers are putting up the capital. The drivers are putting up the cars for Uber to utilize. And you might say, well, isn't that unfair for drivers? You could argue that. You could argue that. But at the same time, drivers get also significant convenience advantages. Working for Uber is a lot more convenient than working, let's say, at Starbucks or Target or Walmart, where you have to stick to a set schedule and you have a manager looking over your shoulders telling you when you can take a break, when you can take days off, how long you have to stand on your feet, and the things you have to do. Whereas if you work for Uber, you choose your own schedule, you choose when you take a break, you're responsible for your own earnings. And a lot of people, a lot of drivers have liked that convenience advantage and they've joined Uber and increasingly spent more time driving for Uber, whether it be for delivery or for rides. All right, now that we looked at those things, let's look at valuation. And whether you look at Uber's forward price to earnings or price to free cash flow, the stock is near the cheapest valuation it's been in a very long time. Price to free cash flow, it's trading at price to free cash flow of 21.83. That's the lowest it's been going all the way back to July of 2022. And then if you look at forward price to earnings ratio at 19.44, that's the cheapest it's been in some time as well. And both of these metrics are below the average stock in the S&P 500. And at the same time, Uber is demonstrating significant growth in both revenue, profits, margins, cash flow, returns on invested capital. Now, the reason the valuation has become this cheap, I believe, is because the overestimation in the risks from autonomous driving, which I will talk about in just a little bit. So that risk has really brought down the valuation for Uber and created this opportunity for long-term investors. So I just shared with you the multiples valuation for Uber. I've also done a discounted cash flow valuation for Uber with multiple scenarios. So my base case scenario has Uber's intrinsic value per share at $112. And of course, that's way above the current market price of $61 per share. My base case scenario uses a beta of 1.34 and a long-term growth rate of 6%. But I've also done several scenarios, various long-term growth rates, 5%, 4%, and 3%. The values in those scenarios are 101, 93, and 86 respectively. So even if you believe the long-term growth rate of 6% is too high, even at these three lower growth rates, the valuation is still undervalued in those scenarios. I've also done various beta scenarios. The current beta is 1.34, and I did a valuation using beta 1.5, 1.75, and 2. And in all three of those scenarios, well, I should say two out of the three scenarios, it shows that Uber stock is undervalued. At a scenario where the beta is much higher at 2, even in that scenario, that would mean the price is fairly valued, $65 versus the current market price of $61. So looking at those various scenarios, that also points to Uber stock being undervalued. So now let's look at the projections and the risks. So the ride-hailing market is expected to experience substantial growth according to Statista. The market is estimated at 167 billion in 2024, and that's expected to grow by roughly 5% each year, growing to 213 billion by 2029. So not very great growth prospects are forecasted for now for the ride-hailing market. So the expectations are not that great. If you look at online food delivery, that market is much more robust. The revenue in the online food delivery market is forecasted to reach 1.22 trillion in 2024, and it's expected to grow at 9.4% to 1.91 trillion by 2029. Much larger market, right, that Uber operates in. It's a smaller part of Uber's total revenue and profit right now, but according to these forecasts, it wouldn't be surprising to see the food delivery side or the delivery side of Uber's business grow to exceed the ride sharing side of Uber's business, which again points to my feeling that the risks of Uber going out of business because of autonomous cars is overblown, because the food delivery side, the autonomous cars will not likely take over that part of the business. You still need somebody to go inside of the restaurant, pick up the food, and go back into the car, or go into the grocery store, do the shopping, and go back into the car and deliver it to customers. That part of its business is less exposed to autonomous vehicles. Speaking of autonomous vehicles, the market for autonomous vehicles was valued at just over $41 billion in 2024, relatively small, right? And it's expected to reach 115 billion by 2029. So again, relatively small. It's not going to grow to take over every single rideshare in the next 5 years. If anything, driverless car technology being everywhere is, I estimate, more than a decade away. Incrementally, it will grow as these driverless cars become more capable, but the point in which every ride is being a driverless ride is very far away for many reasons. Number one, the technology is not yet able to do that, right? These cars cannot operate in unfavorable conditions. These cars cannot operate in areas that are not well mapped. These cars cannot operate when the weather is not great. And then on top of that, you have the situation where people won't be willing to get into a driverless car. They may say, no, thank you. I don't trust them. I'm not going to go with that. So it's not going to take over. And I think the risks have been overblown. And I agree that there is a risk to Uber's business from driverless rides, from driverless cars. But I think those risks are way overblown, not just overblown, but way overblown. So I think Uber's valuation is discounted as a result of these risks being overblown. That's the main contributor of Uber's undervaluation, in my opinion, is the forecasts for driverless cars being way too optimistic and therefore the downside to Uber being way too pessimistic. So, for all those reasons, I've selected Uber as my top stock to buy in 2025. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.